Hi guys, I welcome you all to the first video with regard to SEBI current affairs for the month of October 2018, which are very important for the upcoming SEBI Grade A 2018 examination. So let's start with the first news item, which is SEBI allows Bandhan Bank to offload promoters' stake early. So SEBI has recently given a relief to Bandhan Bank and it has given these relaxations to the bank. And now this microfinance turned banking entity can offload. That means it can reduce the promoter's stake within 12 months of its listing. Now, as per the SEBI regulations, it is mandatory that there is a 1-year lock-in period for promoter shareholding after listing on exchanges. So from the date you have got listed on the exchange, the promoter's shareholding should remain intact for at least 1 year. So there is a lock-in period. But this lock-in period was creating problems for the Bandhan Bank and it found itself against the RBI's policies, and the RBI had pulled up the bank for not complying with its requirements, and the requirements of RBI, which we are going to just look at the coming slide. So they were required to be complied, and that's why the SEBI had allowed this relaxation to Bandhan Bank. Now, Bandhan Bank was listed recently in March 2018 and its promoters were required to wait until the next of March, that is March 2019, to sell their shares, but this was creating problems in complying with the RBI norms. Now, as per the guidelines issued by the RBI for licensing of new banks in the private sector, where a non-banking financial company, as in the case of Bandhan, it launches a private bank, then it must reduce its promoter holding to 40% within 3 years of starting operations. So as per the RBI guidelines, where NBFC is launching its private bank, the promoter holding has to be reduced to 40% within 3 years of starting your operations. Now Bandhan Bank started its operations in August 2015. So it was required to reduce its shareholding to 40% by August 2018. However, the SEBI listing norms, it proposed a ban on transfer of shares within 1 year of listing. So this was required to give relaxation to Bandhan Bank with regard to this 1 year lock-in period of SEBI. And now the SEBI has given the relaxation, the things are in place, and now the Bandhan Bank is very happy about it. Now next is SEBI gives nod to Oman oil futures contract on BSE. Now I believe you all are aware that Oman is a country which is there in West Asia and it is engaged into trading of oil. And SEBI has recently given its approval for launching an Oman oil future contract on the BSE, that is Bombay Stock Exchange. Now this is important because this is the first Oman crude oil futures contract that SEBI has allowed. Now why this futures contract is being allowed in India? Now this is because India is somewhat related to this Oman crude oil, and let's see how. India is the world's third largest oil consumer and importer, but India does not buy huge amounts of oil from Oman, but the Oman oil is a benchmark for the supplies which are made to Asia. So this is a benchmark, and this benchmark is used by Indian oil refiners for making purchases in the spot market. So this benchmark is ultimately influencing the purchases which are being made by the Indian oil refiners in the spot market. So that's why this futures contract has been launched, and this is going to allow the refiners to hedge their risk through this participation in these future contracts. Now another important fact is that from 1st of October, the BSE has made its entry into commodity derivatives segment with the launch of gold and silver futures contract. So this is something which we have to remember. Next is SEBI further improves transparency in mutual funds. Now from now on, all the scheme related expenses, including the commissions, shall be paid from the scheme only. So if there is a mutual fund scheme, no expenses shall be paid from any source outside that scheme. All the expenses have to be met from this scheme only, and they cannot be met from the books of the asset management company which is managing the assets of the mutual fund. The expenses, they have to be met from this scheme only. Further, SEBI has done away with upfront commission of 1% which was earlier allowed, and now the commission will be paid only on a full trail fee model in all the schemes. Now this means what what was the practice earlier? Earlier the practice was that these mutual fund houses, they used to give distributors upfront commission whenever they sold the mutual fund units to an investor. But now this will not be the case. The commission will be only given when they ensure that the investor remain invested with the scheme. So trail model means that investor has to remain invested with the scheme, and then only the commission will be given. But in upfront commission, only for initial purchase the commission was given. So this was wrong, and the mutual fund houses, they were giving these kinds of commissions to distributors, and the distributors were ultimately, after making more and more sales, moving investor from one scheme to another to earn more kind of commission. So this was something which was not a healthy practice. So that's why this has been done. Further, all the fees and expenses which are charged in a direct plan will not exceed the fees and expenses charged under such head in a regular plan. So the direct plan and the regular plan, all the expenses in the same head, they should properly match, they should not exceed. So we'll learn about the regular and direct plan in the coming slide. Now SEBI announced a raft of measures which are designed to improve transparency in investment expenses. So if you are following the SEBI related news, you would recognize that SEBI has been taking a lot of measures with regard to transparency in mutual fund schemes, and SEBI wants to reduce the continuous churning in the portfolios and mis-selling with regard to mutual fund schemes. Now let's take a look at what are direct and regular plan in very simple terms. Now regular plan is one in which the mutual fund pays your broker a hidden commission every quarter. Now this is a very blunt statement which has been made. Now when you are in a direct plan, you are investing in the mutual fund through a broker. So there is a broker involved, you are paying this broker, and this commission is being given to the broker, and this broker is sort of guiding you or sort of giving you information regarding the mutual fund. But when it comes to direct plan, then there is no broker, you are directly investing with the mutual fund. So in this way, no middleman, no intermediaries involved, and hence no commissions are required to be paid. But this does not mean that direct plans, they are suited for everyone. Direct plans are generally good for those investors who wish to invest in mutual fund schemes by directly dealing with the asset management company without the involvement of any intermediary or mutual fund broker. Now let's learn more about these reforms. Now SEBI has said that front loading of commissions will now be allowed only in the case of systematic investment plans. So upfront commissions, they are generally not allowed, but they will be allowed in the case of SIP or systematic investment plans. And in this particular case also, if the investor does not stay the full course of this plan, the commission will be only given on a proportionate basis, and the full commission, if it is given in advance, then it has to be recovered from the broker on a pro rata basis. Further, the additional commission which is paid to distributors for investors from B30 cities. So in order to promote the penetration of the mutual funds, some commission is given to the investors, and this commission will be payable for investment only from individual investors and not the institutional ones. So if you are increasing the individual investors, then only we are going to allow you to pay these commissions to distributors, and they will have to be paid in a trail model only. So they cannot be made in an upfront model. Further, the asset managers will also be required to disclose on their websites the return which they are making on the mutual fund schemes versus the benchmark returns for various periods, namely 1 year, 3 year, 5 year and 10 year. So this will have to be done, and proper disclosure has to be made by the asset managers on their websites. Next is SEBI proposes relaxed norms for startup listing. So SEBI has proposed to tweak the listing norms for startups so that it becomes easier for startups to get the benefits associated with the listing of securities. So SEBI wants to make the listing space more attractive for startup companies which are in sectors like e-commerce, data analytics and biotechnology. And SEBI has also renamed the platform Institutional Trading Platform as Innovators Growth Platform. So this platform has been renamed as Innovators Growth Platform. We'll learn about this platform in the coming slide. SEBI has also proposed to reduce the minimum trading lot size which were earlier associated with the startups to rupees 2 lakh from the existing rupees 10 lakh. So ultimately the trade is going to improve with the reduction in the lot size. Also, the minimum number of allottees which were required for listing, they have been reduced to 50, and earlier this requirement was around 200. So some relaxations have been proposed for listing of startups in the Indian stocks market space. Now, if you talk about this institutional trading platform, so this platform is a window on the stock exchanges where startups, they can list and trade on their shares. And the advantage they get is that they can list without necessarily coming up with an initial public offer. So they need not bear the expenses, the regulations of IPO, and they can simply get themselves listed without doing an IPO. So SEBI had introduced it to facilitate the listing of startup companies, new age companies, so that they can get themselves listed and raise the capital so that they can expand, they can grow. Now, if we learn more about these reforms, SEBI has proposed that this IGP platform, so ITP has been renamed as IGP, it should be designated as the main board platform for startups. So it should be marketed as a main platform for startups, and there should be an option to trade under the regular category after 1 year of listing. Now earlier, the current rules, they provided that an entity which is listed on ITP, it can migrate to the main board only after 3 years of listing. But now this has been proposed to be reduced to 1 year of listing. So it is going to promote more and more companies to enter the market through this IGP platform. Further, it is proposed to remove minimum reservation of allocation to specified categories of investors. Now the present rules, they require that 75% of the offer to the public should be allocated to institutional investors and 25% to non-institutional investors. And now it is proposed that there should be no such a reservation which should be made with regard to these categories. Now next is NPA crisis, an opportunity to develop a bond market, and this statement has been made by none other than SEBI chairman Shri Ajay Tyagi. So SEBI chairman has made this statement that there is an immense opportunity for development of bond market, especially in the backdrop of NPA crisis in the banking sector. So NPA crisis, this has hampered the working of the banking sector. It has hampered the flow of credit from the banking sector to the corporates. So now the corporates, they are looking for an alternate way of raising money, and this can be in the form of raising money through bond market. So it is said that the corporate bond market could get a boost if sectoral regulators like pension funds, provident funds, insurance firms, if they allowed their regulated entities to get higher exposure in the bond segment. So if they are allowed to have higher exposure in the bond segment, then this is going to ultimately improve the bond market. And further, SEBI is also working on putting in place the announcements which was made in 2018-19 budget to raise 25% of the financing needs of large companies through the corporate bonds or through the issue of bonds. So this 25% requirement, it has to be complied with, and SEBI is operationalizing this announcement. Further, in the medium to long term, there seems to be no other option but to shift from bank financing of projects to bond funding. So this is what the statement has been made, and it is being felt that in the medium to long term, the bond funding will be a great portion of the total funding in the economy. Next is insiders using front entities will be subject to more scrutiny by SEBI. Now front entities mean that there are some persons who are insiders in the company, but they know that if they themselves enter into any kind of transaction, fraudulent transaction, they will ultimately come under the eyes of the law and they are going to be punished. So they do not directly enter into such transactions. They use front entities, or what we call them mules. So they are using these entities such as their drivers or domestic helps or maids to benefit from the price sensitive information that they are possessing. So SEBI is now going to take action against such kinds of insiders who are using these front entities. So they lend their names, trading accounts, or execute trades on behalf of others. So this is going to subject to more scrutiny such as financial background checks. And for this particular purpose, SEBI is also trying to introduce a new set of index which we are going to learn in the coming slide. SEBI could soon deem the trades by the investors beyond their verifiable financial sources as fraudulent, and this we are going to study in the light of the new index being developed by SEBI. So this move has come in the wake of numerous instances in which front entities, they were being used to carry out the transactions to conceal the identity of the person who was the real beneficiary behind this transaction, of the insiders who wanted to make gains by using the price sensitive information which they were possessing. Now this proposal is related to TK Vishwanathan Committee on Fair Market Conduct of SEBI. So this proposal to do the background checks are based on the recommendations of this high-level committee, which is chaired by the former Law Secretary T.K. Vishwanathan on fair market conduct, and this committee is aimed to detect, prevent and punish such market conduct which is linked with abuse of market and manipulation of market. And in this context, SEBI is also planning to widen the ambit of deemed fraudulent activities under the SEBI's prohibition of fraudulent and unfair trade practices norms. So SEBI is having these kinds of norms to prevent unfair trading and fraudulent trading in the market, and SEBI is now going to expand the ambit of fraudulent activities so that more and more people, more and more activities, they can be covered under this norms. So the expansion, they will include misleading information on a digital media like internet, front running by non-intermediaries, mis-selling of securities, misutilization of client account, diversion of client funds, and so on. So all the different kinds of unfair practices, they are going to be now put under the deemed fraudulent activities under these PFUTP norms. Now let's come to the index which I was discussing about in the previous slides. Now this is affordability index. So SEBI is planning to introduce this affordability index, and this will be on the same lines as CIBIL. So this CIBIL tells you the investor score, the borrower's score, that whether this person is fit for taking a loan or not. On the lines of CIBIL, SEBI is planning to introduce affordability index. So this index will be prepared based on the income or net worth of the investors. So we are going to take into consideration the income or the net worth of the investors, and we are going to make sure we are going to identify whether this person can invest in the securities market, whether he or she is capable of investing in the stock market or not. So this affordability index score will establish whether an investor, whether an individual is fit to deal. This is very important, fit to deal in the securities market. So the object is to enhance the due diligence by the different market intermediaries if the investor is trading beyond the specified limits which is within his affordable reach. So if the trading volume by any person is substantially higher than the affordability index, so if it was calculated by using this index that the investor, it can enter into a trading transaction of worth rupees 50,000, but that investor has entered into a transaction of rupees 10 lakh. So this means that this is a suspected transaction and this person may be having a mule account. This person may be just a front account and there may be someone behind this person who will be the real beneficiary. So we are going to take an action against this person. Next is single investment regime in the work for NRIs. So India may soon have one investment avenue for non-resident Indians. So SEBI, what is trying to do? SEBI panel has suggested that NRI and portfolio investment scheme routes should be merged with that of foreign portfolio investor norms. So it has been told that NRIs, they are also investing money from abroad, and foreign portfolio investors, they are also doing the same. So the regulations, they should be clubbed for these particular persons. So there should be a uniform regime for all the foreign portfolio investors. So this merger is going to help SEBI regulate NRI investments in India, as the regime is currently more or less on unregulated front. Now NRIs are currently allowed to invest in the Indian stock markets directly and indirectly through the multiple routes. For example, they can invest directly in the Indian companies under the portfolio investment scheme which is there. They can also purchase the fund units, they can invest in private equity funds, and they can also use the offshore FPI route. Further, the NRIs and PIOs, they are allowed to invest in debentures of the Indian companies and purchase government securities. So they are entering into different kinds of transaction in the Indian securities market through multiple routes. And the NRI investments, they are governed under FEMA, besides having to abide by the SEBI regulations and the FDI policy. So this is the present regime, and now we are going to bring a merger of the routes which is going to have a uniform regime for all the foreign portfolio investors. Now this is linked to HR Khan panel on FPI regulations, and SEBI recently eased the norms on NRIs last month based on this panel's recommendations. So we have to relate this panel to the NRIs and to foreign portfolio investors. So this panel was set up by SEBI under the chairmanship of former RBI Deputy Governor HR Khan, and he is being assisted in this task by different professionals to review all the FPI regulations. The committee has submitted its interim report to the regulator recently and is expected to submit its final report soon. Now all the terms here which are mentioned like foreign portfolio investment, etc., and these we have already discussed many times in different sets of videos, so I have not gone into detail in this one. So I believe you are all aware about these basic concepts by now. So now let's move on to some of the MCQs related to this topic. SEBI regulation mandates a dash lock-in period for promoter shareholding after listing on exchanges. Options are 1 year, 2 year, 3 year, or none of the above. So friends, as we have covered that SEBI regulation, it mandates a 1 year lock-in period for promoter shareholding after the listing on exchanges, and we have clearly studied this concept in the light of the case of Bandhan Bank. So the correct answer is going to be option number A. Next question. SEBI recently approved the launch of first Oman crude oil futures contract on which of the following exchanges? BSE, NSE, MCX, or NCDX? So this also we have seen that this first Oman crude oil futures contract is being launched on the Bombay Stock Exchange. So the answer is going to be option number A. Next question. According to SEBI's recent regulations, all mutual fund houses will have to pay commission via options: upfront model, full trail model, either of the above, or none of the above. So this also we have discussed that all the mutual fund houses from now on will have to adopt a full trail model. So the answer is going to be option number B. Next question. Which index is being planned by SEBI on the lines of CIBIL to decide whether an individual is fit to deal in the securities market? Options are credibility index, affordability index, worth index, or none of the above. So this also we have discussed that SEBI is planning to introduce this new kind of index, which is affordability index, for this particular purpose. So the answer to this question is going to be option number B. So friends, these are the answers. So friends, this is all about our discussion on the first part of the current affairs for the month of October 2018 relating to SEBI. Thank you.